Lost contracts. When you're talking about the issue of responsibility, is a vendor capable, reliable, with integrity, etc., there's a couple other things you can look at than just references. And one of them is lost contracts. You want this vendor to specifically tell you what contracts over the past in a given duration, 2 years, 3 years, 5 years, excuse me, has it lost? And then you have to define what lost means. It means either that were terminated by the customer or that where there was an available renewal option that was not exercised. It doesn't mean they did a new procurement and they were underbid by somebody else. That's not the issue. The issue is where an agency basically got rid of them, or a vendor got rid of them by terminating, or they could have exercised an option, they didn't. That means there's something wrong. So you want to know that. And by knowing that, you can then potentially go and talk to the customer that terminated them to find out why they terminated them. So we want this information. So for such contracts, the vendor should provide the specific reason for losing the contract, the same contact information listed for the references. Usually this request is more appropriate for sealed proposal procurements. Usually this will be an evaluation criterion or part of one. This will be an element in judging if an offeror's proposal is reasonably susceptible of being selected for award. For sealed bidding procurements, this information can only be used for a yes-no decision on whether the lowest bidder is responsible. This is usually a tougher decision than if a proposal is reasonably susceptible of being selected for award and injects an element of complexity that may be too much for most sealed bid procurement. So I don't know if I've ever seen a sealed bid procurement that's asked for this information, but you could, but this is frequently asked for in sealed proposal procurements. Let's see. Legal action against the vendor. This is another thing of consideration. Requires information on any lawsuits filed or legal actions taken by a government against the vendor within a given period of time. So that's the first thing, the government action. So a lawsuit of any kind or a legal action taken by a government. So you want to know these things. Again, is the vendor being sued left and right? Or has it been various states or whatever have filed suit because they haven't paid taxes, they haven't paid their employees the minimum wage, that type of thing. You want to know that. And again, within a given period of time, you say within the past 2 years, last 3 years, etc. The other thing, because what you find out by asking for these things is the subtleties where the vendor doesn't have to give it to you because of a situation where it may not have a legal action. It may know that someone intends to sue them, but since they haven't already sued, it wouldn't provide that to you. So what we do to get around that is tell them to also provide information on known pending legal actions. What has been filed within X period of time, what do you know is likely to be filed against you? And again, we want to know the circumstances so we can try to see if there's a reason why this vendor is getting a lot of lawsuits. Virtually all the same information and cautions and considerations from the lost contracts information applies for this topic. Another thing about responsibility is financial solvency. This is something that's extremely hard to deal with. And first I'll describe what it is, and then we'll talk about the wisdom of requiring it and the complexity of it. For most multi-year contracts or contracts that involve a great deal of reliance on the state, reliance by the state on the ability of a vendor to perform, it may be appropriate to request information that will permit a determination of whether the vendor has the financial ability to fully perform the contract. Excuse me. In other words, whether it seems to have the ability to pay its employees, subcontractors, suppliers, and faithfully perform the requirements of the contract. And do that until such time as payment by the state is made or will start being made. So basically, can they cover their expenses until they get paid? And that comes into when are they going to get paid, what's the likelihood they're going to get paid, things of this nature. But you want some idea that they're not going to be saying, well, I can't finish your contract because I can't pay my subcontractors, so can you give me some advance payment so I can pay my subcontractors so they can do the work so I can give the work to you? You don't want that situation.
Have Have you built into the contracts where you do a partial payment? You know, 25% up
You're
front and then
getting ahead of yourself. Some review of a vendor's finances may be advisable to try to determine that the vendor is not on the verge of bankruptcy with the prospect that we'll pay and not have anything to show for it. And the advisability of doing this is related to whether the advisability of getting this type of information is dependent on whether we do have bonding, insurance, the level of the bonding and insurance, whether we're only going to pay after something has occurred, not something where we may be paying in advance, and the deliverables under the state contract can readily be obtained from other vendors. Those are facets that go into this. The more recourse the state has to insurance, excuse me, bonds, payment upon performance, other vendors doing the same work, etc., and other ways to meet its needs, the less need there is to delve into a vendor's financial condition. So that's why you have to make a decision as to whether this is something where you want to go. Financial circumstances of a vendor can be very confusing and very hard to decipher, so that only in the most obvious circumstances might it be apparent that a vendor might be in financial difficulty, and this is part of the reason for requiring bonds and insurance. There's reasons to do it, there's reasons not to do it. We currently are reviewing a proposal from a vendor that has lost money for 2 years, has current negative net worth, and we are very much questioning whether that vendor is in the prospective condition to receive an award.
Absolutely.
And what we do, fortunately, we have a CPA who works at DBM, and so we've given this to the CPA and asked him to look at this, because we know there's all kind of subtleties. Vendors can play games, and they can make like they're losing money when they actually are not losing money because of things like depreciation. So for the unsophisticated, which I certainly am one of those, just looking at it, it may look like there's something wrong with a firm, and it may not be. There may be someone that's guaranteeing their finances, which is not obvious from the balance sheet and the income statement. If they've been in business for 30 years and seemingly always have been in financial difficulty, where there's something that's going on that they've been in business for 30 years. So it's something to look at, but you don't want to necessarily make a lot of judgments on this unless something is absolutely certain.
You have a discussion with the vendor?
Yeah. In this particular instance, we've sent them a letter and asked them questions in advance, because this is a responsibility determination. So before we've even gone to discussions, it's, can you shed a little more light on your current financial circumstances? Things don't look good from what we've seen. Discussed in class on insurance and bonding, these types of security are not panaceas, the bonds and the insurance, and often they are discouraged because of their dampening effect on resident and small minority vendors, and as per the previous slides on lost contracts and legal actions, requiring financial solvency information and making a financial solvency determination usually should only be made for sealed proposal procurement. Types of financial information to request. 1, 2, or 3 years of financial statements. Financial statements usually means income statements, profit and loss, and balance sheets, assets versus liabilities. The preference should be that these statements will have been independently audited, that you have a CPA firm, etc., that audited and can state that they are correct as far as they can tell, that they do represent the position of that firm, the finances, etc. And whereas publicly owned companies are required to have their statements independently audited, privately held companies are not. So if you make a requirement that categorically they must have income statements and the income statements must be audited, independently audited, that requirement alone, which seems like a very nominal requirement, can be prohibitive to a privately held company that doesn't do that. So what we generally do is don't make that an absolute. We will say if they're a publicly held company, we want this information. If they're privately held, they should give us this if they haven't. If it's audited, fine, but give us other information in addition for us to make some conclusions. If privately held vendors have financial statements, they may claim, and probably will claim, that those statements are confidential, so they won't give them to the state. Since we're not required to divulge them to anybody, we don't want anyone to know what our financial position is. No, we will not give that to you, to the state, because we know the state, we know governments, you have to give everything up under PIA requests. So we can't afford to let our competitors know how much money we're making or how little money, whatever it is. And our answer is, they should be told that PIA requests for such information will be denied. That is one of the permissible denials of a public information request. Confidential, commercially sensitive information, and whereas the balance sheets of a publicly traded corporation are public information, that's not the case for privately held companies. So if a vendor balks because they say they're privately held, don't want to divulge it, we will tell them, then give them the citation of how that is properly not to be divulged, and say, now that you know it's not going to be divulged, give it to me. That's the bottom line. You have to provide it, and if they refuse to provide it, then you can eliminate them because they are not responsible. They have not provided required information within the time frame that they were given to provide the information.
And the courts honor that, not releasing the PIA request for private companies.
I don't know if it's ever been contested, but I certainly know there have been no instance I'm aware of where it ever has been not upheld.
The Public Information Act would have definitely gone after confidential or otherwise.
Yeah, that's a permissible exclusion. The types of financial information listed on the next slide should be required, plus vendors can provide any other information they think is appropriate. So this is what we typically ask for. Evidence of financial capacity, such as copies of the last 2 years, year-end audited financial statements or best available equivalent, an analysis of those. That's the independent audit. Dun & Bradstreet rating, because Dun & Bradstreet will do a very in-depth analysis of vendors' cash flow and things of this nature, and will give actual ratings, which are used by other companies as whether they're going to extend credit, things of this nature. Not everyone has a Dun & Bradstreet rating because they have to pay for it, but if they have it, they can give it to you. Line of credit. If you can get something from a bank that says, yeah, we've given them $1 million line of credit, have done it for 5 years, we'll continue to do it in the future, that means the bank's saying they're an okay credit risk. Successful track record, financial track record, don't know what that is. They just have to tell you something and seemingly you'll judge whether that meets that. Working capital, do they have reserves? Do they have actual, aside from their expenses and everything like that, do they have retained earnings, stuff that is available to use to sustain them? But that's the kind of thing that you'll typically want someone with more financial capability to look at that. Any questions on that? All right, alternate and multiple proposals. We've talked about this in earlier classes. Only applies to sealed proposal procurements. In sealed proposal procurements, you are required to state whether either or both of multiple and alternate proposals are permitted to be provided to you. And there can be limitations on the portions of a proposal that are subject to multiple or alternate approaches, such as only staffing, only experience levels, and if either or both are permitted, it must be stated how these may or must be submitted. I'm going to tell you the difference between multiple versus alternate, because they are not the same thing. Multiple means multiple ways to provide what is required by the solicitation. The RFP can allow multiple proposals but limit the number that may be submitted, such as an original or a primary and one multiple or two multiples. Or it may not give a limitation. But believe me, first of all, most of the time agencies don't permit them. And even when they do permit them, usually no one provides them. But it's something that you can do just to allow a vendor, if they want to distinguish themselves from the competitors, they can do it. It's like, what's the downside? The downside is you may have a vendor taking you up on it and giving you something additional. And the upside is you may have a vendor taking you up on it and submitting something additional for you to consider. So it's the same as if almost if you've gotten one more response, even though it's from a vendor that gave you a different response already. This may mean different levels of intensity with different associated prices, perhaps a very intensive approach involving a lot of vendor resources and a corresponding high price, perhaps a moderately intensive approach with a moderate price, perhaps a minimal bare bones approach with a relatively low price. That's what multiple means. They're all trying to accomplish the same objective. It's doing everything within the context of the RFP, not taking any exception to anything, but it's telling you, I can do it this way, I can do it this way, or I can do it this way. With each one having more resources, more people, more activity, and a different price. In other words, if it's doing a public relations campaign, you can have a public relations campaign that has 5 spots aired, and that'll have one price. But if you do a public relations campaign and have 100 spots, it's going to cost more. It's probably going to be more effective because more people are going to see it, but it's going to be more expensive than 1 for 5. It's all doing the same thing, public relations spots, but it's telling you I can do any of this. I could do 1,000 of them. And it's just what you, the agency, want me to do and how much you're willing to pay for it. That's what multiple essentially means. Offerors usually will not know how much the state has available to pay for a contract to try to avoid either pricing themselves out of an award, because sometimes if they don't know what that bottom line affordability is, they may not know that they're giving a price that is just so unaffordable you look at it and kind of laugh, say, yeah, go away. Or the opposite, submitting a proposal that is low price but that the state may judge as being too meager to effectively do what is needed. So offerors may like the ability to offer the multiple level of effort approach. The other part of that is usually the state doesn't know what it can get for the funds it has. So even if I told you how much I had, I don't know what you'd be willing to give me for that. So again, allowing the multiple proposals may allow us to see how much more we could get for a given additional amount of money. And sometimes we might say, well, gee, if I knew it would only cost me another $20,000 to go from 5 spots to 100 spots, I'll spend the extra money and take the 100 spots. I didn't know that I could even get that much for that little amount of money. And if I'd only said, give me 1 proposal, I may never have found out. So both the offerors and the state may benefit if multiple proposals are permitted. Or differing pricing levels may not be an issue. Maybe it's a different way to satisfy the requirements that aren't very different in price. But again, the offerors don't know whether the state prefers one approach over the other. So if I can do it by A method or B method, and I don't know, but the state really likes A method, and I propose B method, I may find myself being either eliminated or not selected because I proposed B. And if the agency didn't do what they should have done and discuss it with me, that I could have found out they liked A, because I could give them A just as readily as I gave them B. So multiple approach means you can do that. Or even without multiple approach. If you allow them for discussions, they can still do that. Offers may prefer to show that they can perform the work however the state wants. So that's the upside. Now we go to the downside. Everything has its ups and downs. Multiple proposal means more work for both offerors and the state in terms of preparing and reviewing proposals. Offerors usually are never required to submit multiple proposals, but some may feel that the state expects multiple proposals if the state permits them. It may be better, maybe, this is where we're not telling you what the right answer is, better to not allow multiple proposals and have vendors determine what they think is the best single approach and then defend that approach. So issues of cost, et cetera, can be worked out through discussions and BAFOs. So that's the counterpoint. If multiple proposals are permitted, usually, so here is the part about if you allow them, how do you treat it? Because you have to tell the vendor, now here's what you need to do if you do elect to give a multiple proposal. Usually the requirement is for the offerers to identify one proposal as their primary proposal. So one of them is going to be complete in all respects. It's going to be the primary. And then any other proposal will then be separately identified, proposal 2 or multiple 1 or whatever you want to call it. But you'll tell them how to identify it, to differentiate the one versus the other, which is the primary. And any proposal besides the primary one typically will only contain the information that is different from what is in the primary. You tell them that in your solicitation. If you give a multiple, that multiple should only contain the information that is different from the primary proposal, because usually 90%, 95% would be identical information regardless. So you want to focus on the difference, and you want them to highlight the differences. They tell you what's in the multiple, and then you want them to explain how is that different from their primary proposal, and all that must be stated in the solicitation. All right, there's something else I'm going to, well, okay, multiple proposal, yes.
When it comes time to compare, and you have one vendor that gave you a second option, but nobody else did, how do you rank that one technically? Or I can see the financial might be different, but...
Well, the question is, if you have 4 or 5 vendors that respond, you allow multiple proposal, 1 out of the 4 or 5 vendors gives you a multiple, how do you treat that? You treat it as if it's a separate proposal from that vendor. And so you'll be reviewing 2 proposals from the same vendor. So the things that have to do with financial capability and lost contracts and lawsuits and references and things like that, they'll get the same consideration. But then when you go to the approach, you'll decide, is one technically better than the other? And it may be that you actually rank the multiple proposal higher than the base proposal or primary proposal, or the opposite. So technically you'll rank them the way you think it should be. And then when you open the price, then you'll decide if there's a price differential, is the multiple worth the price differential or is it not? So it's as if it's almost from a different vendor, but you treat it as a separate submission. So you can find the multiple not be reasonably susceptible and the primary be reasonably susceptible. You can do that. And you can have discussions with the vendor, and you can have discussions on the primary, and you can then sort of go into discussions on the multiple, almost as if you're treating them as 2 separate submissions from 2 separate vendors. Now, it isn't done a whole lot because most people don't understand how to do it, and they just don't want to be bothered. And the reality is, if a vendor thinks there is the right way to do something, then they're probably going to only want to give you 1 proposal. But you have the ability to allow it. So that's what you need to know. You have the ability to make a choice. Alternate proposal. An alternate proposal means one that has taken an exception to at least one requirement of the RFP. I want to emphasize that. They are saying that something you have said they are to do, they're not going to do. And they're not saying they're not going to do it just because they want to be difficult. But what they are saying to you basically is, we're taking an exception to this because focusing on what you want to be achieved from this solicitation, we think we can achieve the results better by doing something different from what you have specified than if we did what you specified. So it is in your best interest, State of Maryland, to take our alternate proposal than to actually take the one that does what you ask us to do. So it is taking an exception that if you did not allow an alternate proposal, you'd say, can't have that, because it's an exception to something that you've required to do. So that you even either have to have them withdraw the exception or you have to do an amendment to allow the exception. Here you don't have to do either if you allow alternate proposals. And the second thing there is what is very important. By submitting an alternate proposal, an offeror is essentially saying that it thinks it can satisfy one or more objectives of the RFP better than by doing what the RFP requires. The result of an alternate proposal supposedly would be a better result for the state. That's what you're looking at. That's the focus. It's a better deal for the state in terms of either price, product, or both. That's what they are trying to do, is convince you that if you take their alternate approach, we will be better off for doing that. An alternate proposal may benefit offerors. An alternate approach may allow an offeror to differentiate itself from its competitors, enhancing its chances of being selected for the award. The alternate approach may be less expensive to the offerer. If it can do this thing, it can come in and do what we want and offer a much lower price. And obviously a much lower price is beneficial to the state, simply because they have the capability and the expertise to do it that way versus the way we have specified. May have more experience, perform better, less cost, but to the state none of this matters unless what is good for vendors is also good for the state. We don't care if it's less costly for you. We want to know, does it work better for the state, and are we going to pay less, and is that paying less still going to get us what we want? So you can tell us the alternate, tell us how it's better for the state, and we'll decide whether we want to select the alternate, reject the alternate, whatever we want to do. Same as, again, as if it's a separate proposal, because that's what it is, a separate proposal. As with multiple proposals, the RFP can limit the portions of the RFP that are subject to the alternate approach. Which parts can have alternatives? And that's something that you should consider. Instead of just saying you can give an alternate to anything and everything, you can do one of two ways. Specifically say what portions may have alternate proposals, or taking the opposite approach and saying what portions cannot have. And frequently I've done it where the location where work is to be performed can be either the vendor's location or the state's location. Or sometimes when we have given suggested staffing, well, the first thing is we do suggested staffing if we even do any suggestion, but allow them to give you different staffing levels. If you have minimum experience requirements, you might allow them to come in with offering different experience requirements, etc. So you can tell them what can or cannot be on the table for alternate instead of just the whole thing. Or the opposite tack, doing what cannot be. And again, there can be a limit on the number of alternate proposals submitted, 1, 2, and I don't think I've ever seen more than one extra proposal from anybody. If an alternate is allowed, the RFP must state whether an offer is permitted to only submit an alternate. And this is important. Can they only come in with a proposal that deviates from the RFP in some respect? Or must they come in with a fully compliant proposal, and in addition to the fully compliant, can they have an alternate? And my preference is, yes, they have to give a fully compliant, and then they can do one beyond that, but they just can't come in with an alternate. So at least we will have a proposal to evaluate from that vendor, and if it's just the alternate and we don't like that alternate, see if that vendor didn't submit at all. Let's see, whether it's fully compliant and may submit an alternate in addition to a fully compliant second, etc. The RFP must also state how the proposals are to be titled: primary, fully compliant, alternate 1, alternate 2, just some methodology. As with multiple proposals, the offeror should clearly state in its alternate proposal what is different, and then the bottom one, why it believes its alternate approach is better for the state than what the RFP required. It has to take the initiative to say what is different and why, if the state would accept that alternate proposal, it would be better for the state than if it simply took the primary proposal. So you can immediately focus on that difference and that rationale. As mentioned in the section on performance-based contracting, the allowance of alternate and to a lesser degree multiple proposals can lead to better outcomes than what the state initially specified. But with the greater flexibility afforded by alternate proposals comes the prospect of greater responsibility and effort. Depending upon how radical an alternate proposal is, it may be difficult for an agency to effectively compare it to the other proposals that are compliant with the RFP. Difficulty comparing perhaps very different alternate and regular proposals is a factor in why alternate proposals are rarely permitted, but this factor alone should not preclude the possibility of alternate proposals. First, as previously mentioned, there can be limitations upon the aspects of the RFP subject to alternate, and second, an agency might have a default position that unless an alternate proposal is clearly superior, it will not be considered for an award. All right. This is a real consideration, and we had a situation within the past 6 months where an agency started off with not permitting multiple or alternate proposals, and the vendors, supposing more than one vendor, said, well, why don't you let us do an alternate proposal? And they said no. And then somehow that there was continuing letters and things like that about we think it would be in the state's best interest to allow alternate proposals, and the agency relented and did a modification to allow alternate proposals. And it got at least one. And then its first question is, how do we treat it now? This is different than all the rest. So what do we do with this different proposal? Because it's so different. And the answer is, you look at what the objective is of the solicitation, what you're trying to achieve. And you make your decision as to whether that alternate seemingly achieves the objective better than the other people's proposals. And if it does, you award to the alternate. That's the beauty of sealed proposals. It doesn't have to be exactly alike. It just has to address the same issue. And if it does, and you think one's better than another, it is not treating vendors unequally if you take an alternate from one when no one else submitted an alternate. Or even if they did submit alternates, if those alternates were very different, you still pick the one you like.
The main thing is you gave all the others the opportunity.
You gave them the opportunity. And they know what the target was. The target was the objective. And if none of the alternates are perceived to be better, then you don't take any of them. So you are left with what you would have gotten anyway if you didn't allow alternate proposals. There is no limitation on the aspects of the RFP subject to alternate approaches. The RFP might say that the agency reserves the right to only consider an alternate proposal that is clearly perceived to be a better solution to the state for the award, i.e. if there is doubt about the viability, I have to learn to read, of the alternate approach, the agency can notify the offeror that the alternate approach is no longer under award consideration without the need for discussions concerning that approach, even if discussions are held on the regular offer. So you might reject the one and still deal with the other. Possibility. Such wording in the RFP permits the agency to decide if it wants to hold discussions, etc., on an alternate proposal. If it can if it wants, but it doesn't have to if it has no interest in the alternate proposal. Note that this option only pertains to alternate proposals versus regular proposals, because the general rule is if you have discussions with one, you have discussions with all. But you can make that distinction for alternate. Among regular proposals, well, I just said that. Usual rule is that they must be treated the same with the same opportunity for discussions, etc. If the RFP doesn't have wording permitting different treatment of alternate proposals, they should be treated the same as any other proposal in terms of being the subject for discussions, cure letters, etc. So if you don't have that wording that says that unless we clearly can tell that an alternate proposal is better, we have the right to eliminate that without discussions, etc., even though we will still treat the regular proposals with, have discussions with vendors, things of that nature. So if you don't have the wording that allows you not to, then you must. Treat them as if they're just a proposal from anybody else. With the same amount of discussion and the evaluation effort expended on the alternate as for the regular proposal. All right, assuming an RFP requires a base, regular, or conforming proposal and not just an alternate one, when discussions are being held on the regular proposal, they should also be held on the alternate proposal. So if you didn't have the wording that takes it out of the realm where you can do discussions, then same meeting with the vendor, you can discuss both. You'll discuss one, then you'll discuss the other. And maybe you'll even have more time with that vendor because you're discussing two different proposals. But both of them will be in the running as if they were two separate proposals from two different vendors. Particularly true for the oral presentation. Typically, more time should be allowed for the oral presentation of an offer with an alternate proposal that is still under consideration than with an offer with only a regular proposal. If the decision in the planning stage is not to permit multiple and/or alternate, there should be discussion of the possibility of changing this decision in the procure stage based upon questions or suggestions from vendors or other legitimate sources. And so you can decide, even if you didn't originally, that you're going to do a modification to allow it, and you may not have to do a lot of reconsideration if you've already done a contingency plan in the planning stage. Conclusion. All the issues discussed on the 19 preceding slides need to be considered in the planning stage when deciding whether to permit multiple and/or alternate proposals. While it is true that multiple and alternate proposals can lead to more work for agency personnel and award complications, these factors should not automatically result in a decision to not permit such proposals. The state might benefit from the added variety of choice provided by such proposals. And I know probably most of you just think this is almost mandatory language. Neither alternate nor multiple proposals will be accepted. And probably very few people even think about what that says and about the fact that you don't have to say that. So all I'm trying to do is give you both sides of the equation. You have the right to allow either or multiple and alternate. You have the right to allow them within restrictions. What can be, what can't be. And so it's just another consideration for you to decide for what you're procuring, does it make sense? And even if the initial decision is no, you put it out. If vendors come to you or write letters or at the pre-bid say, will you accept an alternate? You can do an amendment, say, okay, we'll accept an alternate. And if you want to put limitations, put limitations. Flexibility, decision making. It's rampant in procurement. Here's something that has some similar sound to it, but it's very different. Add alternate bids. So the first thing is this is for a sealed bid procurement and not a sealed proposal procurement. The multiple and alternate is pertaining to sealed proposals. This is sealed bid. And what this involves is when you have a procurement and you have a number of things you want done, but you don't think you can afford all of them. And so you state the specifications, you get a price for each of the components, and you list the order in which you want to obtain these components. And so that when you open the prices, excuse me, you can, first of all, you'll look at what's called the base bid. That's the thing everyone must bid on and give a price to. And if all you can afford is the base bid for the lowest bidder, then you don't go any further. You don't do any of the add alternate bids. But if that's lower than what you can afford, then you go to what you have said is your number one order of preference for an alternate or an add requirement. And you look at that price. And if you can afford that, then you're going to take the base bid plus the add one. Then you go to add two, and if you can, and see if you can afford that. If the answer is no, then you award base bid and alternate one only. And basically, not basically, in the pricing class, we have, I don't know, maybe 10 slides on this. We have examples of how this works. It isn't used frequently, certainly not in the sealed proposal environment, and certainly most of the time not for services, but for construction it's used frequently, maybe for maintenance it's used, and it has value when you're not sure what you can get for the money you have available. And the limitation is, again, you have to list the order in which you're going to add these other requirements in, because what you can do if you don't is get in a situation that, again, our favorite two bidders, he's lowest if I take the base and alternate two, and she's lowest if I take the base and alternate one, and I like her better than I like him. Who wouldn't? And so I'm going to pick base and alternate one so I can get her because I don't want him. If you don't specify, that's the kind of thing that it can appear like you're doing. You're making the selection based upon who you want to pick rather than just who's going to give you the price up to the point that you no longer can afford it. Take the pricing class and you'll learn a lot more about that. Single contractor task orders. We talked about multiple awards. We talked about multiple awards with master contract and secondary competition having to do with task orders, and now this is something that's different. This is something that isn't used frequently, but it's something that exists. And that's where you can make a single award and still have the vendor give you activity via task orders. And they will, in their task order, you will tell them what you want done, and they will give you a technical plan for doing that and a price. And you'll simply decide, yes, I want it, or no, I don't want it. Or you'll negotiate to get something more in line with what you want, and you'll either tell them to proceed or not proceed. The vendor that has your contract to do that activity. And the caveat is that they must use the prices that they bid at the award stage to construct the task order prices. If it's unit prices, they must use no more than. They can always bid less than, but they can not exceed the prices they gave you at the initial award stage. So let's see. Form of indefinite quantity contract. Like most indefinite quantity contracts, this type has defined units and a known overall scope. Unlike multiple award task order-based contracts discussed earlier, only one vendor receives an award to perform all activities, but exact work assignments projects aren't known when the contract is awarded, so the mix and quantity of units to be used for a given project isn't known at the time of award. When the contracting agency wants work done, it describes what it wants, and the contractor provides a detailed plan to do the work. The work plan will include the approach, the personnel, subcontractors to be used, time frames, etc., and either a fixed or a not to exceed price to do what it has described, based upon the fixed unit prices contained in the vendor's financial bid or proposal. And that is key. Must be no higher than those prices, those unit prices it gave you at the initial award stage. Agencies can negotiate with the contractor in terms of adjusting the approach, required resources, time frames, price, etc. For a task order, the vendor can charge less than the unit prices it quoted in the financial. In the final analysis, the contractor will be told to proceed or not proceed, or proceed on a revised basis. In other words, the project may be scaled down to reduce the price. That the project will not be done because of dissatisfaction. Oh, three choices. Either you're going to do it as they have provided it to you, or you're going to do it perhaps with a different scope, reduced scope, etc., or no, we don't like what you've done, what you proposed, or the price, so we're not going to do it at all. Do it as proposed, do it less than proposed, or don't do it at all. That's the choice. This type of contract should only be done if the agency has expertise in the subject of the contract and knows when the approach and proposed level of effort for project are appropriate. The nature of the work is not crucial in that the agency will not be desperate for the work to be done at virtually any price. You don't do this if, no matter what they do, you're going to say, I got to take it. So again, this isn't used very frequently. Possible work approaches in auditing, public relations, non-crucial IT projects, where you have the leeway to decide to go ahead and get it or don't get it. The incentive for the contractor under this type of arrangement is that if it proposes a good work plan and holds down the price, it's going to get work. If it doesn't do that, it's not going to get work. The solicitation for this type of contract should also reserve the right to do standalone procurements whenever the contractor's proposal isn't accepted. So we're not going to say you're the only one that can do this activity. You'll give us a proposal. If we don't like it, we can go out and do a standalone procurement. Will not guarantee any level of work to the contractor, and will state that the contract may be terminated without liability to the state if the agency believes there are too many instances where the contractor proposes a non-feasible or too expensive work plan. If all you ever give me is something that doesn't make sense and is just prohibitively expensive, this doesn't make any sense to continue, I'll just terminate for convenience, and I don't have to pay you anything because of it. So that's what all that says. Any questions on that? All right. Okay, travel time and expenses. for indefinite quantity contracts that require the contractors to perform work at different locations. Indefinite quantity, that's the key thing, different locations. The solicitation should say, and you should actually say in the solicitation, whether you will or will not make payment for travel. And travel can be either two ways, in-state or out-of-state. And generally, in-state is going to include Washington, D.C., and maybe even, you might say, within 10 miles, 20 miles on the Maryland border, etc. And you might define that as being in-state. Now, I don't know how much reason there is to go out of state, but if there is a possibility, you can address that. What you want to address in terms of the expenses is twofold. Whether you're going to pay actual expenses, like for the gasoline and the wear and tear and tolls, etc., and whether you're going to pay for the time of the people while they're driving, because that is an expense. If it takes an hour to drive somewhere, that's an hour the person isn't doing something they're getting paid for. So do they get paid for their time of driving? Issue, dispersion of the possible work location. Usually travel time and expenses should not be paid. So this is the general recommendation. If the second thing there, if this is true, if all work locations are in the same general area, don't pay for travel. Because if you can tell them everything's going to be in the Baltimore metropolitan area, defined, let's say, within 20-mile radius of City Hall, they know where they can go. So they may know that they're pricing to go anywhere within 20-mile radius of City Hall. So they don't have to be paid for something they know what the possibility is. So that's a situation you won't pay. Conversely, you might pay if work locations might be greatly dispersed, such as they may on a given day be in Cumberland one day and Salisbury on the next, and they have no idea how many times they're going to Salisbury, how many times they're going to Cumberland, how many times they're going to, what's Garrett County? Oakland, or places of that nature. And when you're talking about a couple hundred miles one way or the other, maybe they need to be paid for travel. Whether to pay for travel depends on whether for each location it can be stated how many occasions will occur or a maximum. And even if there's great dispersion, if you know they are going to go to Cumberland 10 times in a year, and if you know they're going to go to Salisbury 8 times in a year, they can include that in their price. Because they know where they're located, they know where they themselves are located, they know how far away it is, they know how many times they're going, they can price it. What you price is the unknown, not the known. Or what you allow them expenses is for the unknown, not the known. They have to include in their price the known. If it is known how many times the contractor will visit or the maximum number, it may be possible for the vendor to include appropriate pricing in its financial quote. If so, there is no reason to pay for travel time or expenses. Payment should be considered for unknown expenses, not known ones. Isn't it amazing how these things sound like what I say, and I say what is on there so frequently? If it is determined, now we're going to focus on mileage versus time. If it is deemed appropriate to pay for mileage, give a reference point where the miles are going to be measured from. And that could be the location of the agency, the location of the contractor, the home address of a contractor or subcontractor doing the traveling. Give them a defined point of debarkation. State whether payment will be made for all mileage from the reference point or only mileage beyond a certain distance. What we generally do is say we will pay for mileage beyond 25 miles because, for instance, I commute 42 miles to work. So a vendor can go and do something within 25 miles and do it within normal commuting time. That's our general rationale. I live in Baltimore and I work in Annapolis. Well, I live in Baltimore County and I work in Annapolis. So I drive 9 miles to get here versus 42 miles to get to Annapolis. All right, so see, I like to be here all the time.
Do you get mileage to that?
No, I don't get mileage. because you only get mileage if you go further than your normal commute, not shorter than. Mileage beyond a certain distance from the reference point. Means payment for travel by car. Payment will only be made for travel beyond, well, I said that 10, 15, 25 miles, etc. State the payment for travel will be at the same rate as paid to state employees. So you don't have to define it because state employees, it's out on the website. I guess it's, last I checked, it was 58 cents. It's been so long since I've gotten any reimbursement, I don't pay much attention to it. 55? Okay. State whether tolls, parking, etc. will also be reimbursed. So you should address that.
For the sake of completeness, it's not on the procurement or on the planning issue, but reimbursement at the HMH is at the full rate unless only if you use your own vehicle and a state vehicle is not available. So you have to if a state vehicle is available.
Well, that's for you personally, a state employee. That is not an option for a vendor.
No.
Yes, that is the state reimbursement policy that you do not get paid to use your own car if you could have used a state car, or you would be paid half the rate if you elected to use your own vehicle. But usually, well, that's not part of this, so we'll go on. State the proof of distance traveled or the expenditure that must be submitted with invoices. You're also going to want to say, what do you, vendor, have to submit to document your charge for mileage, for tolls, for parking, for whatever, so that you try to do this to minimize problems when the vendor is under contract and they submit bills and you go back and forth and they say, wait a minute, you never told me that before. If I'd have known I had to do that, I'd have set things up differently. Tell them. Makes it easier. That was for expenses. Now travel time. Say if payment will be made for travel time. If it's appropriate to pay for mileage, it may be appropriate to pay for travel time. In the same theory, if we have to pay you to go somewhere further than what we expected, maybe we should pay you for the time that it took to get there as well. Usually this will be the time of the driver, but if there are passengers that legitimately make the same trip, also address their travel time. If you're requiring the vendor to have 3 people at a meeting, and all 3 people are going in the car, they're all taking the same time to get there, so if you're allowing time for one, you should allow time for all. Now what you may do is you don't just pay the hourly rate in there that they bid for work under the contract, because the presumption is the hourly rate that they quote is for them productively doing work where they're going to have some indirect that's going to be supported by that. They might have secretarial time, IT resources, etc., none of which is going to apply while they're driving. So you might state, either allow for a different rate to be quoted for travel, or just say arbitrarily, we'll pay you 75% of your usual rate for travel time if you're going to allow it, which is on the next slide. I.e., travel time will be paid either at a flat rate, 20, 25, etc., or 75, 80% of the usual rate that they put in their financial proposal. So if you pay it, you have to specify what you're going to pay. Now we're going to out-of-state travel. If travel is required out of Maryland and nearby states, more than 25, 50 miles on the Maryland border, generally actual expenses will be reimbursed, such as airfare, hotel, meal, car rentals. Additional recommendations to specify. The travel expense reimbursement will be the same as for state employees for expenses for which reimbursement has been established. And the reimbursement has been established for meals and hotel rooms for some locations, and I think car rental mileage. But there's a lot of things that there are no specification for state employees, so you can't say they're going to be bound by something that doesn't exist. But you say where there are reimbursement rates, that's what they'll be paid for. And then for things where they're not reimbursement rates, they will be paid actual expenses for items, activities for which no state employee reimbursement rates have been established, provided documentation is provided of the actual cost. So we have an actual receipt of the hotel room, the car rental, whatever it is, and they're reasonable. They didn't take a charter flight to go from California to here when they could have done coach on a regular scheduled flight, that type of thing. And you can also give a maximum that will pay actual expenses not to exceed $200 per person per day, something like that. The recommendations for in-state travel time listed on those slides might also apply for out-of-state travel. However, out-of-state travel is more likely to involve air, train, etc. travel with time spent waiting in terminals, as well as on the actual flight, etc. It must be specified whether there will be any payment for such time expenditure. Do they get paid any time because they go to an airport, they take 2 hours to check in, they sit and wait, they spend a 3-hour flight? Is any of that payable? Usually the answer is no, but you need to consider it. All right, now we start getting into some other things. If it is known both where out-of-state trips will be made and how many, or a maximum, then you don't pay the time, the travel expenses, etc. You have them either included in overhead or included as a separate billing price. And we do this in the pricing class. We show all this. And this is one in particular that we have in the pricing class. If most of the vendors that you deal with are located far away, and you know that they're going to be coming to Maryland at various times to attend meetings or do certain things, number one, they know where Maryland is. All they have to do is look on the map. Number two, they know where they are. So they can quote a price for each trip to come to Maryland. So if they're in California, they can quote a price of $1,000 per person per trip. And we can have that as a pricing element in the price form, so that it's something that's taken into consideration in the award. And what that does is legitimately favors an in-state vendor over an out-of-state vendor, because an in-state vendor is already here and doesn't have to incur expenses. An out-of-state vendor will have to incur expenses to get here. And the thing that you should not do, let's see, is what is at the bottom here. Don't say that expenses will be reimbursed at cost and exclude them from the price form. If they can give a discrete price, it's a cost you're going to pay. If they're located in California and you're going to pay $1,000 each time someone comes to Maryland, and that's $900 more than someone in Maryland would cost you, that's $900 additional dollars. So that should be an element in the price form. So don't take out of the equation something that can be priced and is a legitimate cost to the state. So we say, if they can calculate how many, just price per occasion, you can do a model, you can have them price it, it can be part of the award determination. Does that make sense? If you take pricing, it'll make a lot more sense because we go into detail with actual examples. All right. And we said that. All right. Anybody have any unreasonable requirements? Unreasonable requirement is that I expect you to stay here till 4 o'clock, right?
We've had some in the elevator, that if there's an emergency, they have to respond within an hour. And sometimes their van is an hour, hour and a half, 2 hours away. So sometimes that gets...
And that's exactly right. The requirement, you must respond within an hour of notice, anytime, day, night, holiday, whatever. And sometimes, and of course, you're dealing with a location where you know where you are, so they have to come to your site. But isn't it reasonable to require them to respond within an hour, anytime, day or night?
Nope.
And We're going to discuss that. All right, solicitations should not have requirements that are logically or practically impossible. Now, remember, you heard that from me first. Don't do something that isn't logical or isn't practical. I.e., requirement that the contractor must respond to a service call for a piece of equipment anywhere in Maryland within 1 hour notice. See, I knew you were going to say that. It is physically, and the difference between your example is you know you're at Spring Grove. And so you know where you are, but there have been requirements that it could be anywhere in Maryland within 1 hour. And you look at where you can't get from one end of the Maryland to the other in 1 hour. There are many places you can't get in 2 hours and 3 hours. So saying you have to do it within 1 hour is a physical impossibility to take that literally. And that's what that says. That's a literal statement. It's not that the majority have to or something like that. It's that anywhere. That's an impossible statement. For most situations, it's also impractical to require 1 hour response time 24 hours a day, 7 days a week. The issue of the only way they can give it is just of sitting there with someone ready and waiting to, at the phone call, drop everything and drive to your location. And is it reasonable for a vendor to have that expense when once a year or once every 2 years you might require it? The answer is no. They're not going to do it. So you specifying it, you may get bids, but the bids may actually, everyone may know that they're never going to do it if you ever call on them to do what's in the specification, because they can't as a matter of practicality. Even if vendors don't object to requirements that are impractical but not impossible, there may be no way to tell if the contractor actually would meet the requirement if called upon. You must respond in 1 hour. Well, when's the last time you needed someone to respond in 1 hour? Well, we have never required someone to respond in 1 hour. So do you know if your incumbent would respond in 1 hour if you asked them? No, you don't know. So you don't know whether anybody can do it, whether even your incumbent can do it. All you know is people are giving you a price that supposedly will include doing it, but unless you had an occasion to need it, you don't know whether they would do it even if called upon. And some vendors may have taken you at your word and thought you actually meant that they had to respond in 1 hour and said, I can't do that, and not bid.
Or priced themselves out.
They priced themselves out or they didn't bid, and because your incumbent knows, well, they don't really mean that, they bid knowing that if you ever called on them, they still wouldn't do it. That's not bidding on an equal basis.
At Walter B. Carter said we had to change our policy on the elevators because we had people trapped in the elevator one time and we were waiting for the elevator man to come and he couldn't get there for an hour. So we made the policy that if somebody gets trapped, you call the fire department to extract them, and then when the elevator man gets there, he gets it running.
Okay.
And that was a basic policy because of lack of resources. They just couldn't get there in a timely manner.
It's
He was coming
impractical.
out of Frederick. It took him an hour to get here, hour and a half.
Mm-hmm. Okay, let's see. Isn't this fun, watching me blow my nose and listening? It's as much fun for you as it is for me, right?
Pass around your closet.
Oh yeah, that'll be even more fun. All right, let's see. If a requirement is for a contractor to initiate a response to a service call within 1 hour, 24/7, not be on site within 1 hour, just begin to respond. But the involved agency is not open 24/7. So here's examples of unreasonable requirements. You have a requirement they have to respond anytime, day or the night, but you're not open. Then why do you have a requirement they have to respond if you're not open? That makes no sense. So if that's the case, there has never been a validation that even an incumbent or any other vendor would satisfy the requirement. No sense to have the requirement. So an incumbent contractor or other vendors that know this fact may actually disregard the requirement when calculating their price response Vendors that accept the requirement at face value and price the responses based upon establishing the capacity to actually meet the requirement will be at a substantial price disadvantage, and the price differential will be entirely because of the unequal pricing circumstance. It could be what the bottom thing there says, that the higher priced firm may actually be less expensive for the real work. They're just pricing something that you know and other people know that you'll never require. It doesn't make sense to do it. And I don't see these frequently, but I still do see them. I saw one time. Only one time did I see one time. There was an agency that had a court reporting contract. And this is going to sound strange. The court reporting, that means someone who come out to record an actual hearing of a legal proceeding that had to respond and be on site 24 hours a day at a location to be specified in Maryland. And I'm like, what hearings take place on an emergency basis anywhere in the state of Maryland that can happen at 3 o'clock in the morning? And on the bizarre possibility that there is such a hearing, how can anyone be there within a half hour of notification? I mean, it's one thing if they say, stay in a hotel across the street from our offices and have someone in that hotel room 24 hours a day, so that if we have this emergency meeting at 3 o'clock in the morning, we'll call you up and you can walk across the street, which is bizarre in and of itself. But that just made no sense. And we said, why do you have such a requirement? And the answer was, well, the incumbent does it. And we said, does the incumbent do it? Have you ever had it happen? No. Well, then how do you know the incumbent does it? Well, they submit prices for it. Okay. Well, and they didn't submit a separate price. That is included in their price to do the work, that they supposedly will do this. I said, so you've never done it. The incumbent knows you've never done it. And all you're saying to me is because they continue to submit responses and give a bid price, and that continues to be in the specification, that proves the incumbent does it. No, it doesn't. Take it out. It is impractical. Can't be done. So they did it. They took it out. What a surprise. Let's see. Other examples, requiring a vendor to have the capacity to simultaneously respond to 4 service calls when the agency only has 2 pieces of equipment. We want you to be able to come and service all of our equipment if all of them go out at one time. And you need to be on hand for all 4 of them that we only have 2 of. Unreasonable. Require a courier contract to follow a schedule to the minute. Here's the schedule. You must be here at 9:01. You must be here at 9:10. You must be here at 9:20. Okay. Are there such things as traffic jams? Is there rain? Is there snow? Is there ever a time when power lines fall down on the road and you can't get through? It's impossible. So you need some leeway. And that's what you have, that's what this means. Unreasonable requirements. You have to look, and are you really specifying something that makes sense? If you're not, don't specify it. And what you have to keep in mind is, even if you've specified this for years and years and years, that doesn't mean someone can do it or will do it if you've never actually had it tested. So you may have this, unwittingly, you may have this circumstance of vendors bidding on unequal bases because the one just knows that you're never going to do it, and the other doesn't know that you're never going to do it. And so it prices as if you are going to do it. Just don't make those requirements. As I said, always do what is good, never do what is bad. Keep that in mind. Now, sometimes you will have unusual requirements that are necessary. They might be unusual, but when they happen, something has to occur. And here's an example of that. And this example was given specifically in the Perform class, and it has to do with Spring Grove. This is where this happened. about 20 years ago. 2 o'clock on a Sunday morning, a state hospital may need a lab specimen tested for a patient. The doctor says that something's wrong with the patient and they need a stat lab test. So if the doctor says that they need a stat lab test at 2 o'clock on a Sunday morning, somebody needs to come and pick up that specimen and do a stat test of that specimen so the doctor knows what to do with that patient. That's a reasonable requirement. So even though there may not have been an actual previous situation when a test was done on a Sunday morning, means it won't happen in the future. And when it happens, it's a real need. Accordingly, a 2-hour response time 24/7 is a legitimate requirement for such a contract, and if and when it is needed, the contractor must respond without fail. But how do you assure the capacity to do something that has never been needed previously? And I want to emphasize, how do you assure the capacity? If you haven't had it tested before, but you need it, how do you check to see whether someone can do it? Have vendors provide references of where they have actually satisfied such a requirement previously. If they were a laboratory vendor, they don't do this just one place. They do this hundreds of places, and some of those places are 24-hour facilities where they probably have had this situation before. So tell them to tell you where they've done this before. Provide a complete description of how they would satisfy the requirement, include the address, phone number, etc., the vendor location from which they would provide the 24/7 response. Certify that specified location has satisfied such requirements in the past, is staffed and equipped to do so currently, is specifically aware that it has been designated as a response location for the state hospital. What the state hospital should do is validate the vendor's identified facility is within 2 hours under most driving circumstances. Call the number at odd hours. Since you are a 24-hour-a-day facility, you have nursing staff, you have people there, you should tell someone to call at 10 o'clock in the morning, call on a Friday morning, call at various times, see whether someone answers, see whether they are aware that they're supposed to respond, see whether they indicate that they would have the capability if called upon, and last one, ask if they are aware that they are going to serve that particular hospital. What is mentioned on the previous slide actually will occur during the procure stage, but it is mentioned here because it must be anticipated what can and will be done during the procure stage. In the planning, you must know what you're going to do. Sometimes you'll state it, sometimes you won't state it, but you know what you're going to do. And in fact, in that, I would state in the solicitation that we're going to check. So appropriate requirements can be identified in the planning stage and included in the specifications, but if no way can be determined to truly test a requirement before an award is made, it may be best to forego the requirement even if it's needed. If you can never test it, then you don't know whether a price includes doing it. Bundling of requirements. This came about 2 years ago, 2009 legislative session, House Bill 102, Senate Bill 187. Literally means anytime a solicitation contract contains 2 or more distinct requirements that are to be performed for all but the simplest of procurements. For all but the simplest of procurements, bundling happens all the time. We usually have more than one thing happen. If you're buying 12 widgets, you have one element of work. If you're buying elevator maintenance, you may have the elevator maintenance, you may have the emergency response time, you may have the warranty, you may have various components of that, and you may require them to do, you probably don't have any escalators at Spring Grove, but you may have other things that are just combined.
Annual testing.
Annual testing. So it happens all the time that we have more than one distinct activity in a same solicitation. Until recently, this was not noteworthy and did not even have a distinct name in Maryland. Until actually 2009, until House Bill 124 and Senate Bill 187 came, I never even used the word bundling of requirements. But after that, I not only used it, but I put it in slides. The perception of, and these bills did pass at that time with the avowed purpose of limiting bundling. And it did that because the perception is that bundling is bad. Bundling is bad, unbundling is good. Is bundling bad? Is less more? So I'm going to give you a couple definitions. NIGP defines bundling as the aggregation of demand by two or more purchasing entities to achieve economies of scale. Economies of scale are good things. They allow you to get lower prices. The federal bundling definition under the FAR, the Federal Acquisition Regulations, listed below basically treats bundling as an undesirable action that should be limited. Feds define bundling as consolidating two or more requirements for supplies or services previously provided or performed under separate smaller contracts into a solicitation for a single contract that is likely to be unsuitable for award to a small business concern due to. So the emphasis is you're taking something that used to be this activity of one contract, this activity in a separate contract, putting them together, and the determination is by doing that, you probably will not have small businesses respond to that solicitation due to the diversity, size, or specialized nature of the elements of the performance specified, the aggregate dollar value of the anticipated award, the geographic dispersion of the contract performance sites, or any combination. So that's what the feds say. If it falls into this, it's bundling, and you're not supposed to bundle. So now we come to what does that mean for Maryland? The essence of the issue is not whether two requirements are combined, it is whether there is a logic or synergy to including the particular requirements in a particular procurement. Does the combination appear to make sense? Are the benefits that the agency derives by having these requirements obvious? And just as importantly, might the combining of these requirements preclude vendors that are capable of performing individual requirements from competing on an award on a combined basis? And those are the things you have to look at. Resident small minority vendors are the ones most likely to be negatively impacted by combining or bundling procurement requirements. These are the very type, as we said before, the state is trying to foster competition from and has socioeconomic considerations to help. So the combining of any procurement requirement should be done with two potentially contradictory objectives in mind. So you have two things you need to consider, and these are at odds with each other. One, try to achieve economies of scale in procurements by offering vendors the ability to achieve a higher volume of sales, presumably in exchange for lower prices. Two, don't unreasonably restrict the ability of any vendor, especially resident small minority ones, to compete for the award. Get economies of scale, don't preclude vendors from bidding for smaller portions of it. They're in opposition. How to achieve both purposes while drafting specifications. Continually question the inclusion of any requirement from the standpoint of the benefit the state will derive from including the requirement, the perceived impact of the inclusion on competition generally, and specifically on whether resident small minority vendors can participate, i.e. what will the state lose if the requirement is not included. So you try to gauge this. And if you put it out on a bundled basis and you get vendors that are complaining and they're small minority vendors, etc., you might decide to do an amendment to unbundle. That's something for you to consider and something you should think of in the planning stage. Continually question including any requirement. If there is little or no loss by omitting a requirement, omit it. The default position should be not to combine requirements unless there is a discernible benefit to the state and no major negative impact on vendors' ability to respond. Even if initially the determination is that, I think I just said that, is that combining certain requirements will not harm competition during the procurement, be attentive to vendors expressing concerns about the combination and requesting removal of certain requirements, reassess the need for the requirement based upon the complaint. In the planning stage, contingency plan positions should have been taken on formulating this been formulated on this issue, whether requirements can be readily deleted if vendors object to their inclusion. So, yeah, easy for you to say.
The thrust to go with contracts that are 2 or 3 years long or
multiple year
contracts is actually an affront to this, because if I were a vendor, I'd say break them down to a year, because that gives me 3 times the competitive option versus you tie it up for 3 years and I don't have access to that.
Duration of the contract is not what's included here. It's combining 2 different things, not how long you're doing a single
Well,
thing.
maybe that could be considered as bundling too, 3 years.
That's not what the bill addresses. It's 2 different activities. And so multiple year, most vendors want multiple year.
But a small company, you know, I don't know.
Well, they may want you to have it for a shorter duration because it's out more frequently for procuring. I guess that's what
Right,
you're saying.
That's what I was looking for, right?
But that would not be within the prohibition of bundling.
Okay.
If in the final analysis it is determined that a particular requirement is essential to the state, don't just curtly deny a request for deletion. Just remember, don't be curt. Tom, Dick, or Harry might be okay, but not curt. Deny a request for deletion, explain why the requirement is important to the state. Any potential vendor can file a protest on the specifications of a procurement. It is better to provide an explanation of why a requirement is needed than to risk a protest from a simple no answer. And it's always possible that once the reasoning for the inclusion is explained, that vendor can suggest ways to achieve the same purpose in a manner that doesn't bar them from competing. And that's why it is good to communicate with your vendors. Once they know what you're trying to get and know why you're doing something, either they might understand and not complain, or they might say, now that I understand, well, let me suggest this. That will both get what you want and not keep me from submitting a bid or proposal. So just another suggestion. Okay. You may make a comment. I welcome diversion.
It's interesting that the bundling bill was passed, session right after the combined 5 different contracts for drug acquisition, 5 different facilities. Some of you may remember that. And the bundling bill came up. We did that for a couple of reasons. One was the obvious potential for economies of scale, and at the time that seemed like a reasonable thing to do. And the second was that we are going to an IT system that will require reporting of drug usage by a pharmacy in a certain manner, certain compliant way with other IT things. So that's why we wanted one vendor, and the intent was to have one vendor for the whole state eventually. So we combined those 5, and fortunately, the winner was a minority small business. Then we got the bill on bundling. So I guess, Joel, the thing that I'm wondering now is that I still have the reason, the IT reason for wanting to do it. I don't recall when this contract expires, but it's probably within the next year or 2.
You can save your breath. It has nothing to do with that.
Okay. Great.
I can tell you specifically why it was passed. Department of Human Resources contract for information technology. Their web hosting contract, they had 2 separate contracts that they bundled into one, and the one was about $70 million, the other was about $30 million. And when they combined it, it was well over $100 million, and they got one response. And a number of vendors complained that it was too big for them to compete, and the legislative auditors then audited and said it was too big for them to complete. And after the legislative auditors audited, this bill came out with the hearing specifically focused on the DHR contract for IT services. Even though the reason why DHR bundled them was to get more competition. And they did that because in the federal arena, 100 million is small potatoes. And so they thought that by bundling, they would make it big enough that they would attract the big players that go after federal contracts. So their determination was it has to get bigger to get more competition. And even though they did it to get more competition, they got knocked over the head for having done it because supposedly it, number one, did not result in more competition from the big guys go after the federal contracts, but also didn't get any competition from the little guys that might have been able to do a $30 million procurement. So that's why the bundling bill happened. Okay, it's break time.